Gold jumps to a new record highs. The Aussie and Kiwi dollars rise another 1% to 20-month highs. Key US inflation data tonight will set the scene for the Fed's next move. Australian job vacancies fall, but they're still well ahead of pre-COVID levels. That's coming up in our 5 Things in 5 Minutes. And then on the subject of gold, in our bonus deep dive interview, ANZ Economist Dhiraj Nim looks through India's recent trade data to find out why there was a sudden rush of gold imports in August.
The trend that the Reserve Bank of India will continue to increase the share of gold in their FX reserves is likely to continue.
But first, in 5 and 5 with ANZ, the S&P 500 and the Euro Stoxx 600 both rose overnight to fresh all-time record highs, as investors celebrated China's wide-ranging stimulus announcements this week. That's also helping the Aussie and Kiwi dollars, which rose to their highest level since the beginning of 2023 overnight. Oil prices fell 3% on reports of extra production, but it's the gold price that's really shining, at record highs again overnight, rising 0.3% to nudge $2,700 US dollars an ounce. More on that later. All eyes tonight will be on the US PCE inflation data for August for any clues on whether the Federal Reserve might follow up September's 50 basis point cut with another one in November. ANZ Research is forecasting the core measure will rise 0.15% month on month. Now that's well under the 0.28% seen in the core inflation measure last time. ANZ Research is forecasting the important core PCE measure will rise 0.15% month on month. That's well under the 0.28% rise seen in the core CPI inflation measure. Remember, it's the PCE measure that the Fed prefers. Here's ANZ economist Bansi Madhavani speaking from London this morning.
The Fed has not yet declared victory on inflation. They do want further progress in coming months to reach their 2% target in a sustainable fashion. But to the extent that disinflation progress continues in the background, the Fed will be driven more by labor market conditions, as they do want to preserve the strength in the labor market. Our view is that the Fed will cut rates by 25 basis points at each of its upcoming meetings this year.
As of 4 a.m. Sydney-Melbourne time, the Aussie dollar was up 1.09% at 68.97 US cents, while the Kiwi was up 1.07% at 63.29 US cents. Number 2. In Australia, as the RBA keeps a close eye on the labour market, data yesterday showed quarterly job vacancies fell 5.2% in August from May, although they do remain 45% higher than before COVID. Here's ANZ Head of Australian Economics, Adam Boyton.
The first thing it tells us is that, yes, there is still demand for labour out there. That's reflected in the relatively high measure of job vacancies. But it also tells us that that demand for labour is cooling and is slowing down, and that's reflected in the fact that across both this ABS measure and our own ANZ Indeed job ad series, vacancies are down broadly 20% over the past year.
Number 3. The RBA said recently it had been surprised by ongoing labour market strength. Adam says the decline in job vacancies should start to be reflected in a slowdown in jobs growth.
It's certainly very true to say that the labour market is a lot less tight than it was, but I think the message I'd take if I'm thinking about jobs growth from these data is that the fall in vacancies does tell us that jobs growth or employment growth should start to decline over the months ahead. Of course, people have been looking for that for a little while. The labour market can sometimes be a bit slow to turn, but generally I think you'd say labour demand is cooling in Australia.
Number 4. Gold has been hitting fresh record highs this week as traders increase bets that the Federal Reserve could plough on with another 50 basis point cut to rates in November. ANZ senior commodity analyst Daniel Hines says the way the Fed kicked off its rate cut cycle certainly drove interest in the precious metal.
The prospect of a relatively aggressive start to that cycle certainly helped really trigger a wave of buying. And I think to date, one of the aspects that has actually been missing from this gold rally has been the involvement in investors in the gold ETF market. And we are seeing that start to emerge as a really strong driver of the gold price. So I think, now with the Fed kicking off its rate cuts, I suspect that flow of funds into gold-backed ETFs is going to increase even further.
Number 5. The gold price hit $2,700 an ounce overnight. ANZ Research expects it could be on its way to $2,900 an ounce by the end of 2025. Daniel says one driver looks to be ongoing purchases from central banks.
That's been a fairly strong support over the past couple of years, really, but there was some doubt, certainly over the last few months with China sort of easing back from its purchases, but other central banks have stepped up to the mark and we saw another strong amount of buying through the last couple of months. So clearly it's an ongoing structural sort of shift in the market, which we think will continue to provide support. But it's not just central banks, it's also retail investors as well that are buying the physical gold, particularly India.
Daniel Hines there, who mentioned that increased demand for physical gold in India. In our bonus deep dive interview today, ANZ Economist Dhiraj Nim sifts through India's trade data for August to find out what's been driving that surge in gold imports. He spoke to my colleague, Alex Tarrant, from a vibrant Mumbai. That's Alex's way of saying there's a bit of background noise.
The trade deficit for the month of August came in at $29.7 billion, which was one of the widest numbers on record. Also substantially higher than what the market was expecting, around $22.8 to $23 billion. Now, among the key drivers, most notably was a sudden gold rush, as I would like to call it, in the month of August. Now, there are various factors why Indians tend to import a lot more gold in August, because the festival season is just going to hit up in the next few months. So there's a lot of restocking demand. But at the same time, there were some one-off factors as well. The import duty cut by the central government in the July budget also contributed, apart from the fact that the Reserve Bank of India was also purchasing a lot more than it usually does.
Just looking at that duty cut, it was quite a sizable cut, I think, from 15 down to 6%. Was that expected, and why do you think the government did that?
Why the government did that is not entirely clear, but may have been a recommendation from the industry. But the cut was certainly larger than what the market had expected or the industry had expected. And the impact of that cut was that the onshore price of gold, for example, in the Mumbai market, fell immediately by about 5%. That could have spurred a lot of wholesale and retail demand for gold during the month.
And then just looking at the Reserve Bank of India's purchases, what's behind that?
Well, I think it's a general trend that we've observed in the emerging market central bank universe of late, that given the geopolitical uncertainties and the macro realities of the world, which include high inflation and high interest rates so far, emerging market central banks have been stockpiling gold in their FX reserves. And this is a trend we think is structural in nature and is likely to continue. And the Reserve Bank of India is merely towing that argument. So the Reserve Bank of India's high purchases were not out of the blue. They have increased their gold purchases in 2024. It was just that the number in August was substantially higher than it had been in the previous few months.
Do you think that will continue from the Reserve Bank of India, or will they start to taper those purchases off, do you think?
I think the tonnage of gold that they purchase would certainly taper down, perhaps back to what the average has been in the year so far. But the trend that the Reserve Bank of India will continue to increase the share of gold in their FX reserves is likely to continue.
Just looking at India's export performance more broadly, what is happening there and what's affecting those numbers?
I think there's a bit of an export fatigue that has set in, and we were just analyzing numbers and we saw that the annual export revenues have not really risen much in FY25 so far, which is the fiscal year ending March 2025, compared to where they were at end FY24. And I think there could be several factors behind it. The first factor is, of course, global growth is slowing. If it is not slowing precipitously, at least there is some sign that demand from economies like the US is weakening. And the second bit is that there is a lot of foreign competition currently in the export market. China has substantial overcapacity, and India's exchange rate perhaps is looking expensive relative to the rest of the Asian docket, which possibly explains why low and medium tech exports from India are not faring as well as high tech exports, and are certainly not faring as well as one would like.
Do you think that trend is going to continue? Because people say over the medium to long term, India is going to sort of start being the tech manufacturing powerhouse that it wants to be.
Well, most certainly. I think that this is a bit of a cyclical story here, the kind of export slowdown we are witnessing. And just to clarify, look, we still expect a soft landing in the US, which means that we may be able to avert a deep export recession. But export weakness is here to stay for some quarters in a cyclical sense. And as you said, of course, from a structural sense, India is expected to become a bigger exporter than it currently is.
Dhiraj Nim there from Mumbai, which you could hear. That was 5 and 5 with ANZ for Friday, September the 27th. Catch you next week with a review of that US inflation data and what it means for global interest rates. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.